we're trying to now think about how to measure the stance of monetary policy. Okay. We know that monetary policy should be such that it closes the output gap, keeps inflation low, and when we look at actual data, how do we make a judgment where monetary policy is? So, remember in the beginning we said that we will look at three approaches to assessing whether monetary policy is doing what it is supposed to be doing. The first approach is what we call the inflation expectations approach. And in this approach, we basically ask the question whether inflation expectations are anchored. Anchored meaning they are able to stay close to, or in fact approach, the central bank's inflation target. But the central bank's inflation target is not tomorrow, day after, but usually over a time horizon, and in some cases the time horizon may be longer, in some cases the time horizon might be shorter. So the question that we ask is, are the inflation expectations of the public moving towards to or are close to the inflation target of the central bank? And in asking that question and posing the question of whether monetary policy is doing what it's supposed to be doing, we are making some assumptions. The first assumption that we are making is that the central bank has an inflation target. It not only has that inflation target, but it is committed to achieving that inflation target. Secondly, that target is known to the public, because only then can the public form some expectations on where it needs to be. And as part of that commitment, the central bank actually does whatever needs to be done, and inflation expectations are high, it actually will tighten monetary policy, and the tightening of monetary policy has an impact on inflation expectations, as we saw in the first picture on the transmission, monetary policy transmission mechanism. And an expected inflation is the only thing that we're looking at when we ask the question whether the stance of policy is tight or not tight, or as we would say, neutral. So we say that if inflation is expected to be below the target of the central bank, then monetary policy is said to be tight or not sufficiently loose. And if the inflation is expected to remain above the target of the central bank, it means that monetary policy is too loose. And if we find statistically that the expected inflation is close to or is equal to the inflation target of the central bank, we say that monetary policy is neutral. It's neither too tight nor is it too loose. Where can we get this inflation expectations data? Okay. As I said, sometimes the central banks conduct surveys of people to ask everybody, well, what is your expectation of inflation? But in the case of the US, there are some market instruments that are issued by the US Treasury, which can give us a measure of inflation expectations. In particular, the US Treasury issues different kinds of government bonds, and there is a kind of government bond that it issues in the market which essentially protects the investors from inflation. It basically says that over a 10-year horizon, so it's a 10-year constant maturity government bond, in which the investor is promised a certain rate of return, regardless of the inflation. At the same time, the US government also issues other bonds in which the interest rate is quoted not in real terms, but in nominal terms. So it is here, the return is a nominal number, 5%. But we know that the interest rate, the nominal interest rate is just the real interest rate plus the rate of inflation. So the difference between two returns here can be considered a measure of expected inflation. Because we're looking at the return on these two bonds on a 10-year horizon. Okay. At that point of time, the real interest rate promised by this bond is, let's say, 3%. And if the interest rate promised on this bond, which includes inflation, is 5%, then it must be the case that the expectation of inflation in the future is 5 minus 3, roughly, or equal to 2%. So when we take the difference between these two returns on these two different kinds of government bonds, US government bonds, we get a picture like this. So in particular, during the global financial crisis, you see that because the economy was in such a large slump, the expectation was that inflation would be very low on a 10-year horizon. But as the economy recovered, the inflation sort of came back roughly to this 2% mark. Sometimes it's above, sometimes it's below. And during this period, before the global financial crisis, the expected inflation measured in this way seems to be around 2.25, 2.5. And then again during COVID, you see that expected inflation drops. So this is a time when the economy is in a recession. And during times of recession, the expectation of inflation can go quite low. And as the economy recovered, and the economy started again producing at a full employment level, the expectation going forward is that the interest rate, the expected inflation, that inflation would go back to a 2 to 2.5%. So using this measure, one can again ask the question, if the correlation between the target of the central bank, let's say in the case of the US Federal Reserve is 2%, is that difference statistically significant or not? Okay. Whether that number, when you average over that period. Now, an analysis was done by the International Monetary Fund in 2013, it's a little while ago, but obviously this can be replicated. So if you were to ask this question from an econometric point of view, how would you do it? What they did was to collect data on advanced economies, because these are the economies in which typically the central bank puts a lot of weight on inflation control, okay, and ask the question, to what extent are inflation expectations well anchored in these countries? So they took a sample from 1900 to 2012. How much is that? 10, 12, 12 and 10. Long enough sample set. 12 advanced economies. So you construct a panel data set. And how do you then state the econometric hypothesis? Well, you state the econometric hypothesis of inflation expectations being well anchored in terms of this particular hypothesis. So you can take the data and just run, let's say, an OLS regression or whatever regression you want to run, whatever econometric, and then ask the question whether alpha and beta are equal to 0. If alpha and beta are equal to 0 statistically, then expected inflation minus the target inflation is just a random variable on the right hand side. So statistically, the difference between expected inflation and target inflation is just a random number. It's not a systematic number. And if that happens, then one can at least say that the data does not contradict the hypothesis of inflation expectations being well anchored. So when this estimation was done, how did they do it? Well, first of all, they took 5 years of data. You take 5 years of data for 12 countries, estimate the number alpha, estimate the number beta, you get one number, then you move the sample a little bit, you calculate another alpha, and you calculate another beta, then you move the sample a little bit more, so you do what is called a rolling regression over a 5-year sample, moving, estimate the alpha and the beta. You see that in the earlier time period up to here, the null hypothesis of alpha being equal to 0 is rejected by the data, because when you take a confidence interval around alpha, it does not fall on the 0 line. But when you go beyond this time period, you see that the standard error band around the estimate of alpha is the 0 line lies between that error band. And similarly here, for this time period, the beta estimate, if you do a confidence interval around it, the 0 line lies in that confidence interval, which means that beta is statistically indistinguishable from 0. That alpha is statistically indistinguishable from 0. You cannot reject the null hypothesis here that alpha is equal to 0, and you cannot reject the null hypothesis that beta is equal to here from 0. So during this time period, one would conclude from this information that inflation expectations were well anchored, and for the earlier time period, let's say here, up to 200 until 2000, because alpha is outside of the 0 band, it could be different from 0. It's statistically not easy to say that alpha is equal to 0, that inflation expectations were not well anchored. So in this part here, one would argue that monetary policy was neutral, and if alpha and beta have so here alpha is greater than 0, beta is greater than 0. So if alpha and beta are greater than 0, one can find out whether expectations of inflation are greater or less than the target. The second approach that we can take to asking the question about the stance of monetary policy is by using the Fisher equation, which relates the nominal interest rate to the real interest rate and expected inflation. And then there is a risk premium. This is basically the Fisher equation. And if we try to estimate, so from this equation, if we had some estimate of the real interest rate for the economy, okay, and we had some sense of what expected inflation is, then I minus expected inflation is the real interest rate, right? And if there was a neutral interest rate that we knew about, so this is constructing the real interest. The real interest rate can be constructed as inflation minus the expected inflation, so that is the actual real interest rate. If we had some idea about what a neutral interest rate is, so what do we need to do the analysis? Yeah. So the Fisher equation is saying that the nominal interest rate is the real interest rate plus the expected inflation at some future time period plus the risk premium at time period. Let's say the risk premium is equal to 0. Then the real interest rate is just the nominal interest rate minus expected inflation. As in the case of the US that we saw earlier, if we had some measure of expected inflation either from surveys or from market data, we already know this. If we know this, we can construct a series for the real interest rate. If we had some idea of an R star, which is the neutral interest rate, if we can find somewhere a neutral interest rate for the economy, then if the actual real interest rate is greater than R star, we would say that monetary conditions are tight, or that monetary policy is tight. The interest rate needs to be at this level, but it's this level. And if the real interest rate is less than R star, we would say that monetary policy is loose. If the actual interest rate is exactly where it should be, then we would say that monetary policy is neutral. The question then is, where can we get this real interest rate from? The real interest rate in an economy is the marginal product of capital. We know from our simple macroeconomics that the cost of capital is the real interest rate. The return to capital, the last unit of capital, is the marginal product of capital. So we would expect that in industrial economies or advanced economies, the real interest rate would be low because you have the marginal product of capital would be low because you have a lot of capital. In developing economies, low and developing economies, we would expect the R to be high. But in a given economy also, because the level of capital might be changing and other conditions might be changing, we might get a level of the real, of the neutral interest rate because the economy is changing. And one simple way, so we got all these problems. We don't know the risk premium. The expected inflation might not be something that we have a good measure of. But let's say, like many other things, if we used to use approximations, then we could construct a simple figure like this, where we can take the policy rate of the central bank, subtract from it our measure of expectations, and get a line for the actual real interest rate. And just like we've been smoothing things out for output and other things, if we were to draw a HP filter through it, we could think of that as the neutral interest rate. The idea here is that at any point of time, the central bank's interest rate is close to the neutral rate, but not exactly the neutral rate, because central bank makes mistakes. It sometimes has policy that's too tight or too loose. Okay? But over time, the central bank's interest rate comes close to the real rate of the economy, the neutral interest rate of the economy. So here, the actual real interest rate of the central bank is less than the neutral rate. Monetary policy is loose. Here, the central bank's real interest rate is above the neutral rate. The policy is tight. Okay. So now that we have some idea of whether policy is loose or tight, the question is it right? It is tight or loose at the right time. Okay. So we've constructed a measure of whether monetary policy is loose or tight, but is it loose or tight at the right point? And if monetary policy is tight when it's supposed to be tight, then monetary policy is doing a good job. If monetary policy is loose when it's supposed to be tight, it is making a mistake. If monetary policy is tight when it's supposed to be tight and loose when it's supposed to be loose, monetary policy is doing a good job. And we can then compare the tightness or looseness of the monetary policy and put it next to, let's say, the output gap and ask the question, is monetary policy tight when the output gap is positive? When the economy is in a boom, you want monetary policy to be tight. When the economy is in a recession, you want monetary policy to be loose because it needs to support the economy. So deviations from, so we can construct this black line as the trend real interest rate, and that can be a measure of our neutral interest rate. So the R bar is the same as my R star. And this could be another way of asking the question whether monetary policy is too loose or too tight, and in addition, is it appropriate or not appropriate for the state of the economy in terms of the business side. A third approach that you have all seen is the Taylor rule. What is the Taylor rule saying? The Taylor rule in this form is also called inflation targeting light. Why is it called inflation targeting light? Because this is a situation where the central bank worries not just about inflation, but it's also worrying about the output gap. So it's not strictly concerned only about the inflation rate in the economy, but also worried about where the economy is in terms of the business side. Now remember that the Taylor rule was something that Robert Taylor basically used as a description of how the Federal Reserve behaved. Okay. It has later on been converted into a rule that countries could follow in terms of their monetary policy. So the general form here is that a central bank should keep a level of the interest rate which is related to the real interest rate plus inflation. So if this is a short-term trend real interest rate or a neutral interest rate, this plus this is, let's say, sort of a neutral nominal interest rate. And in addition to that, the central bank should look at the difference between the target inflation and the actual inflation. If actual inflation is higher than target inflation, C1 should be positive. It should raise the policy rate. If the output gap is positive, we assume that C2 should be positive. If the economy is producing above potential, the central bank should raise the interest rate to tighten monetary policy and cool down the economy. So the second thing to notice here, that C1 has to be positive, and let's say between 0 and 1. C2 has to be positive between 0 and 1. But notice that you have inflation here and you have inflation here. So if inflation is higher than the target rate, the interest rate will be raised by not just C1, but more than C1 or more than the inflation rate. If the interest rate is raised by more than the inflation rate, the real interest rate will rise. Because the nominal interest rate is just the sum of the real rate and the inflation rate. So if the central bank raises the nominal rate, so if inflation goes up by 2%, the central bank, according to this rule, should raise the nominal interest by more than 2%. If it raises it more by 2%, then the real rate would increase. And it's the real rate that is the basis for decision making about consumption and investment in the economy. If the real rate goes up, then consumption and investment would cool down. So that's the basic logic of the Taylor rule. And for the US, Robert Taylor essentially made the conjecture that the target, the neutral interest rate in some senses for the economy, real target interest rate, the real rate is 2%, and that the central bank puts equal weight on inflation and the output gap, and that the target inflation rate for the US is 2%. So when he estimated this kind of an equation, he thought it was a pretty good fit for how the central bank or the Federal Reserve Bank behaves. So from this, we could get an idea of what the central bank should do. If the central bank is not doing this and the interest rate is different from what it should be doing, then we can have an idea whether the central bank is too loose or too tight. So this gives an idea what the central bank should do, but there is an actual interest rate that we see that the central bank has. This number can be estimated with actual inflation. Actual inflation we know. We have an estimate of the output gap. We can get a number for what the nominal interest rate should be. Let's say the nominal interest rate should be 3%. The central bank has a nominal interest rate of only, the federal funds rate is only 2.5% actually. Then the interest rate is higher, is lower than it's supposed to be. The central bank's policy stance is loose. Given that the economy is where it is, and given where inflation is where it is. Now Taylor basically used current inflation here, but we know that, as we said earlier, if a policy action is taken by the central bank, it takes some time for that policy action to transmit through the economy. And we know the idea of the impulse, let's say in terms of the econometrics and the GSGE modeling, there is a time lag between when the policy action is taken and we see the impact on a particular variable. So if there is a lag, then the policy rate should be adjusted before inflation becomes too high. So if you expect inflation to be high in the future, you must adjust the policy rate today, and not when you actually see inflation. So in this kind of a policy framework, the interest rate is adjusted in advance by looking forward, and the other things are about the same. You still have the inflation target, and you have the output gap. So here, and the INT, which is R bar plus the expected rate of inflation, is the policy neutral nominal interest rate. Because this is the real rate plus the expected rate of inflation, which is basically this. And Taylor wrote an article in The Economist where he estimated what the interest rate should be during the period 2003, 4, and 5, and let's say almost 6, using his rule. And what he did was he was actually using this rule, and using that equation, he estimated where the interest rate should be. This is where the central bank policy rate was. Based on this, he made the conclusion that monetary policy was loose during 2001 and 2005. The actual interest rate was significantly below what was required by the Taylor rule. But another economist, Ben Bernanke, who was the chairman of the Federal Reserve during that time period, said, no. The mistake you're making is that you're using this equation, whereas the equation that I'm using, the Federal Reserve was using this. And at that point of time, we were expecting inflation to be different compared to what it was. And if you use the expected inflation compared to the actual inflation, you would find that the central bank's policy rate was okay. So the basic point here is that in assessing the stance of monetary policy, what inflation number you use, whether it's actual inflation, current inflation, or future inflation, makes a lot of difference. And Ben Bernanke's point was that monetary policy works with a lag, and the effective monetary policy should take into account the expected values or the forecasted values of inflation and not the current values. If in the Taylor rule, we take out the output gap, what does it mean? This is a central bank that does not care about the output gap at all. It is not looking at employment and the output gap. It is focused only on inflation in the economy. Something like this would be a good description of the Reserve Bank of New Zealand or the Reserve Bank of Australia. Something like this would be a good description of how the Federal Reserve of the United States works. This would be a good description of what, let's say, the Bank of Thailand does. This may also be a good description of what the State Bank of Vietnam does. It is focused on inflation. We don't know whether it's focused on future inflation or current inflation. We have to ask the government of the central bank. But we also know that in its statements, the State Bank of Vietnam worries about supporting the economy in terms of output level, so it must be worrying about this as well. We also know that the State Bank of Vietnam worries about the level of the exchange rate. So most likely, you would have to put in a term on the exchange rate into this equation to describe the behavior of the State Bank of Vietnam. So to assess the stance of the current policy rate, one compares the actual rate with the derived Taylor rate. If the current rate is less than the target rate, monetary policy is too loose. If the current rate is greater than what it should be, then monetary policy is too tight. And in the case of the inflation targeting framework, we have to once again compare the current rate to whatever is given by the rule. So this ITG, for example, in this rule would come from using this. So the ITG here would be equal to whatever the neutral rate is plus this number. The actual number is whatever the actual number is. So the Taylor looks very, very, very simple, right? Just look at output gap, inflation, but in reality, things are not that easy. Right? We know that there are many ways of estimating the output gap. We did it with the HB filter, but it can be done with the production function. It can be done in many, many different ways, and depending on what estimate you have of the output gap, you will get a different number on where the policy rate should be. And if you get a different number on what the policy rate should be, comparing it to the neutral rate again would be a complication, because calculating the neutral rate also is not that straightforward. So it is not easy in general to make statements about whether monetary policy is too tight or too loose, unless everything is so far from where it should be that everybody agrees. So that's why you have differences of opinion in terms of where the economy is, what the policy rate should be, and whether the policy rate should be tightened or loosened. That's why when you see the policy rate of the different members of the Federal Reserve Board, you get different answers. And one way to think about that is that different people have different ideas about where the economy is, they have different estimates, and they believe that if the economy is in different situation, something else should be done. And on top of that, it's not easy to get a measure of inflation expectations. So what did we do? Understanding inflation is complicated. Okay? Not that easy. The monetary policy transmission mechanism, it's important to understand it, to see how policy actions move through the economy. And then finally, we looked at three ways of asking the question whether monetary policy is too loose or too tight. These three can give you different answers, and all of those answers are a little bit complicated. So let's see whether we can implement some of these ideas in the spreadsheet. So let's open, if you can download the monetary policy spreadsheet from Moodle. It should be E5 monetary policy analysis. So to do a numerical analysis of monetary policy, the first thing that we need obviously is inflation, and we know where to get the inflation data from. We already have it on a quarterly basis. We have the CPI index on a quarterly basis. You can calculate the percentage change, get the inflation on a quarterly basis. Since we don't have a very good measure of inflation expectations, we can just use the forward-looking expectations. So let's say 19.4 or 12.5. Where do I get that number from? We don't have survey data in the case of Vietnam. We also don't have the government of Vietnam issuing different kinds of instruments from which we can extract a measure of expected inflation. So what am I doing here? I say, let me take my previous numbers So I take the average of my previous 4 quarters and say my expected inflation this quarter is based on how inflation has been in the past. This is a simple application of adaptive expectations, where I'm saying that my expected inflation in time period t is whatever actual inflation was in time period t minus 1. I take 1/4 of that. I take my actual inflation t minus 2, t minus 3, and t minus 4, and I take an average of those 4 numbers. If inflation has been high, I expect inflation to be high going forward as well. If inflation drops, if I see inflation dropping, then I expect inflation to be low. So I just use a simple measure of adaptive expectations to form my estimate of expected inflation. Now this is again a number. What is the central bank target for inflation? When inflation is high, these are the targets that the Central State Bank of Vietnam has announced in the past, and we can get some, so this is what we had put in, and we now know that more recently, the State Bank of Vietnam has announced that it wants an inflation rate of about 4%, 4 to 6%, so we can put in that announced target, inflation rate here. That becomes the pi bar that we were looking at. What is the difference between actual and expected inflation? Well, it's just expected inflation compared to the actual inflation.
Still high.
What is the difference between, it should be C16.
C16.
I think in some, we should not have these numbers here. We should basically start here. Right? Because actually, this is the first number that you should start with. Because these 3 numbers, here we are just using different numbers. Numbers don't exist here. First place that we should start is 18.6. Now it makes sense. 2.7 is the difference between 18.6 and 15.9. So there. This is fine. So here in this sheet, we basically simply constructed a measure of expected inflation using the actual inflation. This gives us the graphs. And in your case, in the case of the US, for example, you will actually be able to get some measure of expected inflation, which is not a weighted average of past inflation for advanced countries. And in the case of Thailand as well, you might be able to get that number from somewhere. What other countries are we working on? Germany. Good. You should be able to get a good number on expected inflation. And yours is Germany. That's one good. And Thailand. So I've got Thailand, US, Germany. That's a good choice. Once we have, so we've done the inflation part, but we now need to get some handle on the interest rates. This is the policy rate of the State Bank of Vietnam. And it can be compounded because the rate is on a particular day. Right? And that little compounding gives us this number. We already have a measure of expected inflation from our previous sheet, right? Constructed. And once we have the nominal interest rate and we have the expected inflation, we can construct a measure of the policy rate, the real policy rate, because we have this. We've constructed a measure of expected inflation using that formula. So we can say what the real policy rate of the SPV is. And using the Fisher equation, we can construct a measure of the neutral real interest rate as well. Okay. You don't have to do very much here. You just look at it. So we have the nominal policy rate. Why is these two things exactly the same? Maybe the reason is that these things are so close to each other, it's exactly the same. Yeah. Something is wrong with the F is 0, I should be using E. Sorry.
Mà em mà không có gì không thích mà bị sao hết chứ em is waiting.
Right? Okay. So I take the nominal policy rate, subtract the expected inflation from it, and I get the real policy rate. Now, some the outer years, once again, is looking like there's 0 there, but that can also be fixed. And the reason why we might be getting a problem there is because something is happening to, we don't have expected inflation
we don't have the value.
One second.
E bằng
I should start it at the right place. Here we go. Whenever I have an expected inflation, I will be able to calculate. So that thing you put in the right place and then move it backwards and forwards. The last column you can see is where we have to use the HP filter. Okay. And we have to use the HP filter to calculate the neutral real interest rate. Once we have the real policy rate, we can apply an HP filter. And let's apply that HP filter to that series and calculate it again. Okay, let me come back to that later. I'll fix it and I'll put the answers on your on Moodle. It's not just anything. I cannot even quit Microsoft right now. That's no fun. let me come back to this, or let me see if I have the solutions already somewhere.
I have just fit that. I can run it.
Give me 1 second. Let me see if I want to solve it somewhere and I can explain it to you and then I'll give you the solutions. And maybe this one has the right sort of numbers.
I've just removed the HP filter 5 and then I add in again and it's okay.
It works for you?
Yeah. Just
Okay.
remove the.
Try and finish it and let's see if
Yeah.
the answers look like what I have in the solution.
Is it?
Yes, 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 yes. That's exactly what it should look like. So try and see if you can figure out this file. Let's give ourselves about 10 minutes or so. So if the charts, yeah. So the timing, you have to check the right date. Good. Thank you. It was very helpful. Okay, maybe we can. I'll put the answers on Moodle. You can do it later, but let me try and explain some of the concepts and what it is that we're trying to do, because you'll have to use this sheet to think about your country. Okay? So remember, what are we trying to do? If we have a measure of inflation, if we have measure of inflation expectations, we can either use the Fisher rule or we can use the Taylor rule to ask the question, where should the policy rate be? And if the policy rate is above where it should be, monetary policy is too tight. If the policy rate is below where it should be, monetary policy is loose. Interest rates are too low compared to where they should be. Okay. So what this file is doing is essentially, for example, in this sheet, here is the actual policy rate, the real actual policy rate. Here is the interest rate that should be according to the Taylor rule. If the State Bank of Vietnam did not care about output and cared only about inflation, then this is where the policy rate should be. So once we have these two rates, we can find out the difference between these two rates, and the next chart gives you the difference between the actual rate and the Taylor rate. If the actual rate minus the Taylor rate is positive, it means that monetary policy is too tight. If the actual rate is above the inflation targeting rule, and if this is what the central bank is doing, then monetary policy is too tight. In the case of Vietnam, if the State Bank of Vietnam was following the Taylor rule, during this time period, policy is too tight. And during these time periods, when the difference is negative, policy is too loose. So we found a way and a terminology for asking the question whether monetary policy is supportive enough of the economy, given its level of inflation and given its level of the output gap, which is what we started to do. We wanted to ask the question, is monetary policy doing enough to control inflation and support the economy? And this gives us an answer here. Here monetary policy is too loose. The central bank is pushing too much into the economy. And we don't have, we could put in the output gap here as well to ask the question whether this is the appropriate stance or not, but this is a way of thinking about whether monetary policy is too tight or too loose. Okay? And once you have the data for your countries, this chart will automatically fall out, and you will be able to say whether, in the case of your country, you think monetary policy was too tight or too loose. And I will place the solution file on the on Moodle. I'll place all the solution files on Moodle. So instead of, so you should have everything. Okay. Why don't you take another 5 or 10 minutes to see if you can reach this kind of a chart at the end. I can take a 2-minute break. Let me give you another 5 minutes to see whether it works for you. It should, I think. It's just a question of sort of understanding the concepts and putting the formula at exactly the right place.
formula, yeah, split Q and R.
See, again, I'm losing it because my HP filter is not working. So whenever I try to do anything, even when I try to look for a formula, okay, let's see if I can. Yeah. Link C, in my case, it has to pick up the coefficient
Q and R. Okay.
of the Taylor rule. So when I give you the file, it should work out. So it's picking up the neutral interest rate, future inflation, the inflation target, the output gap, and the coefficients on the Taylor rule, half on inflation and half on output. And if the country is following just the inflation targeting, then there is no coefficient on output. Output does not enter the calculations of the central bank. So if you have a figure that roughly looks like this, well, you depend on where you have all the information to calculate it. So if there are some time period, because expected inflation is something that only starts at a particular point in time. The policy rate we have from the beginning, right? Because the expected inflation starts only after 1 year, right? And because it's expected inflations, we are losing 4 quarters of data. So the real policy rate can be calculated only after 1 year. And only after we calculate the real policy rate, then can we start doing all the other calculations. So you will lose the first 4 observations. So the formulas, I think, will pretty much start after the first year, 2012, when we use that. Let me put this on Moodle, and it will be E5S, so the solution to. So the answers are on and the other files are working fine, so I think okay. So let me start on what I think is pretty much the last topic
Fiscal.
of the course. Maybe if I have about 10 or 15 minutes, I want to talk to you a little bit about exchange rates, but let's see how the discussion of fiscal policy goes. It's a little bit easier